So I guess the basic question is, have they gone far enough? Are we overpriced now in the equity markets? Because they've really marched up.
I'd say valuations are certainly getting to a more stretched level. What we think this really does, though, is put an ongoing burden on a couple of forces. First, we do need to see the ongoing tailwind from a fundamental perspective. Second, we have to keep an eye on 10-year yields, which are around the 4% level, we think send a pretty decent signal for equities. But at this point, it's really the Q4 earnings period that we think is supporting a lot of the action we've seen thus far, and we think it bodes well for the fundamental outlook for the S&P 500 over the course of 2024.
All the talk in your equity area is about those Magnificent Seven, however many you think, 6, 8, whatever they are, the Magnificent Seven. Is that likely to broaden out, and are they likely to keep marching on?
Well, okay, so the Big Seven or Magnificent Seven, really it's three this year. There's three of those components that have contributed half of the index gain year to date. We've been arguing that they become more idiosyncratic in their behavior. That's unfolding. Our big theme, though, has been one of broadening beyond the S&P's exposure to just those mega caps, and we are seeing evidence of that as well. So from our perspective, a broadening from a fundamental earnings growth perspective is mission critical to further upside for the S&P, and what we think that does is lend itself to a broadening from a performance perspective across a broader array of sectors.
So you talk about fundamentals. I interpret that as earnings. Tell me about earnings, where we are in earnings, where we're headed in earnings. I mean, you're actually toward the top of the Bloomberg elves in your projection for where we're going to be getting earnings this year. Yeah,
we're pretty bullish on the earnings outlook and the fundamental picture for the S&P 500 for sure. And what I would say about that is going into the Q4 reporting period, which obviously sets up for 2024, expectations had come down, and so they're being easily exceeded at this point. Again, something that we had expected. We had also expected that we'd see a downward bias to full year 2024 estimates. And in fact, that had been occurring, but we're now seeing some signs of stabilization. We think the path higher for equities from here begins with fundamentals, and there we're quite constructive on the earnings picture. We're looking for the S&P earnings growth in the 2024 timeframe to be in the neighborhood of 10 to 12%.
When it comes to tech, there's a lot of talk about AI and its effect on productivity and where we're going there. What's your take on AI and how it's going to affect equities?
Well, the way we've been viewing it is that it's going to affect it in two ways. First, you're going to have that subset of companies that has a direct beneficiary. You can measure either via revenues or earnings. That's a small subset of the mega cap growth cohort that we've been discussing already. But under the surface, we're looking for AI to lead to productivity enhancements across a broader swath of companies. That's going to be much harder to get one's hands around from a granular perspective, but we expect to see it in margins and profitability.
I'm not sure we call it a fundamental, but what about the election? I mean, I keep hearing that historically, in years where incumbent presidents are running for re-election, whether they win or lose, the markets do well. Do you ascribe to that view?
Yeah, I think the way we're approaching this election is you can throw out historic playbooks. We don't think that a lot of the performance patterns from previous presidential elections will hold out this time. We think there's a different set of issues that need to be contended with, and each of the two candidates, in our view, has some aspects of their policy stance that are not particularly U.S. equity friendly. And so we're going to have to monitor the way their platforms really fall into place over the next several months.
So unpack that a little bit, Scott. I've read your notes, so I sort of have a sense where his taxes on the one hand and trade on the other, I think.
Yeah, so let's start with the latter and trade, right? So we don't think the equity markets are prepared at this point for an across-the-board 10% tariff on imported goods. We would view that akin to some of the supply chain dislocations that we felt in the days, weeks, and months post the pandemic. So we're concerned about the fundamental impact of an across-the-board tariff policy. On the flip side, anything that goes down the path of trying to overturn some of the corporate tax benefits that we got from the first Trump presidency and has to contend with the expiration of the personal tax cuts that are set to expire at the end of 2024 as is, all of that begins to create a scenario where we have to be attentive to the fiscal accommodation of the past couple of years beginning to inflect that something that's a bit more restrictive. That's equity negative.